So this is the cash sale. The cash sale, $1,000, and you get cash in, and you mark up the revenue. Okay, so if you sold on account, this is the journal entry. Instead of cash, you have accounts receivable, and you'll have your sales. Okay, so here's the question. Why is a sale on credit more susceptible to fraud than a cash sale? It's much easier to have a fraud doing
Is it
this.
because you could change the journal entry?
Yeah, but I mean, but why don't we, if I'm going to create a fraud, let's say I'm a bad guy, I'm going to create a fraud, I'm a fraudster.
Or the lapping.
which which one of these would be easier to commit the fraud with? This first one where I have cash and sales, or the second one where I have accounts receivable?
The second one.
Yeah. Why? You're right, but why?
Yes, because it can exist the lapping on it, or the customer can cash another cell when cash another cell it put in the incorrect account receivable.
Exactly. The cash is going to be off. So the cash is going to be off if I, oh, that's a little bit better than it was before. The cash is going to be off. Wait, I maybe can use the other thing now. Yeah, so the cash is going to be off if I'm hesitant to do this because like it's workable, just leave it. But yeah, an auditor would look at that and go, well, where's the cash? Your cash doesn't show this in your cash, but accounts receivable, because there is no cash, it's much more susceptible. So this is a common type of fraud. And sometimes it happens they make up a customer. It might happen that they have a regular customer that they overship stuff to, called channel stuffing. But either way, it's easier to do because there is no cash to be proven wrong, basically. Since no cash is involved. The cash account will still balance. Oops. Whereas if you put the first one in, you'd have a problem. Because you're recording cash that isn't there. It's not in the bank, it's not anywhere. Whereas this one, you can leave the accounts receivable on the books. It's an asset, same as cash is an asset. It's an asset, but it will not show up that the cash is off. Okay, documents, and these are kind of important. These actually go through a number of things, but we'll kind of go through them and see what we have for these documents, and kind of which ones we more rely on for accounts receivable. Okay, a customer's purchase order. This is when a customer sends an order that they want something, and it's a formal document. Oops, requesting a purchase. Usually at a specified price and amount. And I should say in quantity. So a customer purchase order. It's a formal one. It's done by the purchasing department. Oops. So they may have it, they may not. It just depends on what kind of sales they're making. So the purchasing department. You know, not, I mean, not all sales do that. If you think about it, if you go into, you know, you go into Walmart and buy something, you didn't make a purchase order. But you know, but again, so it may or may not be there, but if it's a, you know, if it's a company that usually deals in them, you're gonna look for the customer's purchase order, and that's proof that the customer wanted whatever it is they're, whatever they're purchasing. Sales order. May be based on the purchase order. Will be generated by the sales department. Okay, credit approval. A lot of times they'll have a credit approval department. The credit approval should never be done by the sales department. Credit approval should be say an unbiased credit approval. The set guidelines. So there are going to be criteria that they go by for this. And again, it can't be the sales department. The sales department should never do the credit approval. Okay, and now the one that we're all familiar with, no matter where you, the pick list or the packing list. If you buy something from Amazon, you're going to get a packing list with it usually that will say, you know, what it is, what's included in what you bought or whatever. So pick list is kind of the same thing. It's generated so that they can actually pick the items. I don't think I told you guys about that well before when I was, maybe I did, I don't know. I did this one time on an audit. I think I told you guys about it. But anyway, so pick list is when you they'll be given people in the shipping department will be given a list, and they'll say, okay, here's an order that you need to get the list for, and this is, you know, these 15 items, and you go pick those 15 items or whatever items that are available. There may be some that are missing, and you put them in a box, and then you indicate which ones that were in there and which ones, you know, were not shipped. And usually the packing slip will indicate only the ones that are shipped. So it's only going to be those that are actually found, that were actually packaged, will be on the packing slip. Okay. So this is usually generated by the sales order. And in some businesses, it's fairly common, obviously, and even, you know, today, especially with the supply chain problems. It's funny, like before COVID, you know, 1 out of 1,000 people knew what a supply chain was, and now now it's this common, you know, you say it and everybody knows what you're talking about. But yeah, the supply chain, problems that you order 10 things and you get 3, it is possible. Okay, the sales invoice. Now, the sales invoice maybe differ from the sales order because there might be, maybe not everything was actually shipped. So the sales invoice is for items that were actually shipped. Oops. So if they ordered 10 things and they got 3, you only charge them for the 3 that you actually shipped. This should match the packing list and the purchase order if there was one. Usually the purchase order will have an agreed upon price, and that should be the same thing on the sales invoice. And if there is a change, then it has to go back to, the purchase order needs to be redone and changed. Basically, a purchase order, this gets into contract law a little bit, but a purchase order is the offer to buy something at a certain price. If you say, well, wait, the price went up, I can't sell it to you for that, that's fine. Your new price is now a new offer to the customer. And so the customer would have to approve that before it's actually a contract, a sales contract. So if there is a price change, it needs to go back to the customer, or else it's not a contract. Okay, collection of receivables. We talked a little bit about this already. The collections, but the collection of receivables. Maybe completed by collections department. Or lockbox system. Those are probably the 2 most. And we talked about that, I think, didn't we? I think we talked about the lockbox system. Lockbox is when the bank actually, gets all the takes all the collections, but automatically deposits them, and no one in the bank actually, or no one in the company actually touches the collections, which is a good thing. A list, the collections is sent to the accounts receivable department. And again, they do not get the checks. They only get a list of what was collected from who, and they will credit the accounts. You know what's funny about the word credited? When they say they're going to credit their account, most people who aren't accountants anyways, they think when they say they're crediting their account, that's adding to their account. It's a good thing. It's actually crediting their account is taking it out of accounts receivable and putting it into cash. So the bank, or the company there, if they're saying we credited your account, what they're really saying is that, what you're owed goes down. That's the credit that they're talking about. The cash itself is going to be a debit. It's Oops, let's try to do that again. The cash itself, if you go up to, like up here, when they say they're crediting your account, like when you pay the $1,000, they're actually reducing your accounts receivable. That's what they're saying, that your account is getting credited, the debit's going to the cash. All right. Are these on the same page? I don't even know if I have these on the same page. Are these on the next page or not? I don't know. Probably doesn't matter too much. Okay, two of the most important ones that we have are the bill of lading and less, but still important, is proof of delivery. Okay, so bill of lading is a really important document, and if you're auditing accounts receivable and sales and all that, it's going to be a big one. A bill of lading is when you're shipping something. So it's when you're shipping something. I wonder if they could put this stuff. Works. No, that looks like a criminal or something. I guess that'd be good for this class. This is what a criminal looks like. Actually, I am what a criminal looks like. The most normal person in the company is usually the criminal. But anyway, so here's what happens. So when you ship something, you put it on the delivery truck. Notice you're giving the company the item, but they don't own it. You still own it, or whoever buys it, whoever's paying the shipping usually owns it. So notice that there's what a strange kind of operation that is. So we're giving you our goods, but you don't own it, and you're responsible for it, and you're delivering to wherever. So that's what a bill of lading is. A bill of lading is an agreement between the shipper and the company that's shipping it, the people who are shipping it. It says, here's our package. You don't own it, but you're going to take possession of it, and you're going to get it to wherever it's going. And it usually doesn't have any of the prices on it or anything like that. It's just a description of what it is that they're giving, and it doesn't have to have a price on it because there's no agreement with you and the shipper as to what they're paying for it or anything like that. The shipper isn't paying for it, whatever the item is. They're just shipping it for you. That's the only thing they're doing. So the bill of lading it's a contract. These have been around for thousands of years. It's a transfer of possession of goods to a transportation firm. It has the number of goods, description of the goods, and the weights. Signed by both. Seller and buyer addresses, and now the prices are not usually included. And again, you are not giving title to the shipping company. They don't own it. They're responsible for it, but they don't own it. So it is kind of a strange contract, but that's the way, that's what they are. And it's made so that things can be transported without selling it to the shipper. The shipper takes it, sells it, all that kind of stuff that wouldn't really work in the real world. So anyway, that's what a bill of lading is. Now, here's the important thing about it. It's an agreement with a third party. So you can actually go ask this third party, I want to see the bill of lading, and check to see if there actually is one. And that's going to become important, and I'll tell you why in a second, but it's going to become important when we talk about what's the best evidence. Proof of delivery, similar. You guys can probably guess what that is. It's proof that they actually gave it to it. Yeah, I'm sure if you guys see UPS or Amazon or whatever, they drop something off on your doorstep, they take a picture of it. That's their proof that they gave it to you. Or in my case, I usually take a picture of it, and it's the apartment building next door, but at least with a picture, I know where to go. So these are the documents that we're looking at. Now, not all of these documents are equal. And I can't remember, did we talk about what documents are better and worse? That would probably be a good place to do it right now. There's a hierarchy to documents, which ones are better. And stop me if I already did this. I should, oh, okay, created by. Okay. The best evidence, oops, is created by a third party. Let me get a little more room here. And it's held by a third party. So someone other than the client creates it, and someone other than the client holds it. Okay. We'll say the medium evidence is created by a third party. And is held by the client. Worst evidence is created by the client. Oops. And held by the client. Okay, so these are kind of our rules as far as like, oh, repeated. Yeah, so the best evidence is held by a third party, excuse me, created by a third party and held by a third party. Medium, you get the idea. And the documents that the client creates themselves, that's the worst evidence. They have the document, they created it themselves. Okay, so let's go through these and see which ones are good, are best, medium, worst. I tell you what, let's give these numbers. This is number 1. Scooped up my spacing. This is number 2. And this is number 3. So 3 is the worst. Okay, so customer purchase order. So the customer makes the order and they send it to the client. So we're at the clients, we're doing the audit, and we come across this purchase order they receive from their customer. What
Oh,
is it, 1, 2, or 3?
number 2.
2, yes, good.
Right.
So this would be a 2. This would be medium evidence. It's not the worst. It's not the best either, because they have it in their possession, so they could have altered it or something. But it's medium evidence. Okay, sales order. Now this comes from the client's selling department. We'll make this order. Usually it's based on a customer purchase order.
That's number 3.
It's 3. It's the worst. I'm bold that one too. Credit approval. Done by the client.
Number 3.
Number 3, it's the worst. Pick list or packing list.
Pick list
It's 3.
3.
Yeah, they create it, you know, so it's it's the worst. Okay, I'm gonna try to see if I can get a little room up here. I got a little bit generous on my spacing for my stuff up here, so maybe we can get this back to where it was. Okay. Sales invoice.
Number 2.
This is actually gonna be the worst. It's created by the client, it's held by the client. Collection receivables,
That's number 2, because created by the bank, held by the client.
yeah, good. Especially if it's a lockbox, this would be 2, medium. Okay, now bill of lading. It's created by the client, held by the client. So this could be a 2. Oops. Take that back. 2, medium. But here's the thing. Because this is also held by the shipper, you can actually contact the shipper for the bill of lading. And if you can get that directly from the shipper, you can move this up to the best evidence. So bill of lading can be turned into the best evidence if obtained from the shipper. That moves that up into number 1 evidence. It's held by a third party. It's created by a third party. The third party is part of the ones that will sign off on it. I'm sorry, I didn't give this to you. Yeah, okay. No, I took it. Right now. All right, so we try to and by proof of delivery is the same thing. Well, actually, it'll be proof of delivery will actually be the best. It'll be the third party. If you ask for proof of delivery, it's going to come from the shipper. It could be held by the client, but if you get it directly, it'll be the best. Actually, I'll do it the same as up here. If the proof of delivery is held by the client, it's medium. If you get it from the shipper, it'll be the best. And we're always trying to do this. We're trying to move evidence, if we can, from up the ladder, make it better. Question on that? And now this bill of lading. Here's the thing about the bill of lading that's so important. The bill of lading, it proves that something was shipped. What you're worried about is someone writing up a sales order and say, okay, it's accounts receivable and all that, and there's no bill of lading. There's no bill of lading. It's probably a fraud. A bill of lading actually will have a description on it. It won't have the price or anything like that, but you could match up the pricing with the sales invoice and say, okay, here's the sales invoice. Sales invoice should be only for those things that are shipped. It should match up with the descriptions, at least, on this bill of lading. So it's evidence that at least the client, that there was an honest attempt made to make the sale. Now, proof of delivery says, well, what if the customer didn't get it? Well, that is a risk always in shipping stuff. But just because it didn't get there doesn't mean that they didn't ship it. And so the proof of delivery, while that might indicate that it never arrived where it was going, at the same time, that's not usually the client's fault. The client thought, made an honest effort, loaded those things, the bill of lading, shipper signed it, and the effort was made. It was a a good sale. And if it was lost somewhere, you say, okay, well, what if it's lost somewhere? Then they have to take that sale out, right? Yeah, but a lot of times that there'll be a claim. There'll be an insurance claim on it, and they'll collect on the insurance claim. So a lot of times, even if it doesn't get to the seller, it actually is a sale because the insurance claim will basically cover for what the sales will. So the proof of delivery is not, well, it sounds like it should be the most important one. Actually, the most important one is the bill of lading, because it shows that they actually, got the stuff together, got it on the truck, the invoice matched up with whatever they had on the truck, and then it went out, and there was an honest effort to make the sale. Okay. Let me see here. Okay, let's go through these. Aging trial balance. I'll just give you an example, and that's usually, you guys have done this before, I'm sure. Okay, so let's say that we have accounts receivable. And it's on the books at, let's make it easy, 100,000. Okay, we will split this up into different categories. So let's say the current, accounts receivable is 70,000. Hey, oh, you know what? Hey, how come you're not? Oh, there we go. Okay, 70,000. And you go, okay, and the accounts receivable um 1 to 30 days past due. Clean this up a little bit. Is say 20,000. And the accounts receivable thirty-one plus days past due is 10,000. Okay, so what we've done is we've taken this accounts receivable and we've broken it up. Okay, 70,000 is current, 1 to 30 days past due, 20,000, and 31 to whatever past due is 10,000. Okay, which one of these are more likely to be collected? The current ones, the ones that are past due 30 days, or the ones that are past due over 30 days?
Over 30 days. If not, we have to do something.
Right, well, right. I mean, which ones are we most likely to collect? Most likely to collect, we're going
Correct.
yeah, the current ones. So let's say that this is the so what we're going to do is we're going to do estimated uncollectible. I'm just going to make these numbers up, so if you're wondering where I'm getting these from, it's just from my mind. Okay, let's say that the 70,000, let's say that 2% of those we estimate are going to go bad. So we're going to estimate what's 2% of that? 1,400. I think it's 1,400. Let me get these closer. Okay. Now, past 30 days due is probably going to be a little bit more, right? So what number should we put in there? Anything more than 2%.
10%.
10%. Good. That's a good number too, because I can do that math. All right. So 10% of 20, what, 2,000? And $10,000 is 31 days or more. So how much of those are going to be uncollectible? Something more than 10%. 15? Okay. So say 1,500.
100.
So this will be our estimate of what is uncollectible. So an aging of trial balance is simply that you age it, you take each of these accounts, the total is 100,000, but we're going to age them. And so our total estimated uncollectible will be whatever those are together.
4,900.
4,900. Thank you. And so on the balance sheet, you're going to show accounts receivable, 100,000. Well, here I'll show it to you. Maybe we'll do it. So underneath assets,
Net collectible, net AR.
yep, is actually probably current assets. They have classified. So under current assets, we'll have all the other accounts, but one of the accounts we're going to have is the accounts receivable.
Account receivable and collectible and net.
$100,000. Estimated uncollectible will be minus 49.
Negative.
And so net accounts receivable. And they might just show net accounts receivable. A lot of times they'll just show the net, depending on the company. Was that 95,100? So this is what would be shown on the balance sheet. And a couple things, this uncollectible expense, the estimate will be an expense. So this will show up on the income statement somewhere. And also you're telling the reader, no, look, we got 100,000 of accounts receivable. Don't expect to see that. Most likely we're gonna get about 95,100 out of it. And these numbers a lot of times will be made by, you would say, well, what about these? How do you know about this? One of the things though, especially if the company's been around for more than a year or so, is you can check and see what in the past they've had. In the past, how much of these accounts couldn't be collected. And you can use that, go the actual from years in the past to see what is reasonable, I guess, for these to be. Okay, industry average. And this one it's kind of a funny one in a little way. I'll tell you why. Okay, industry average. Industry average is comparing the client amounts, bad debt, uncollectible expense, with the industry. So you're going to compare what the client says and with the industry. Now, if the client is similar to others in the industry, this might be a reasonable thing to do. For instance, like up here, it looks like around 5%, 5%-ish are going to be uncollectible. Well, let's see what the industry says. If the industry says 5%, that's probably a reasonable estimate. If the industry says, that usually it's 8%, well, that could be a problem. And one of the reasons I say this is kind of a strange one is that this is, I think, I think this is the only example I can think of anyways, where an industry estimate can be used as a what they call a substantive test. In other words, an industry average can be used as a to see if the financial statements are materially misstated. It's usually, you look at ratios and things like that. Usually they just point to where to look. They say, okay, look, the sales look out of whack here or something like that. But this is one where it is reasonable if the company is very similar to the industry, and the industry average is different, materially different than what they're showing. You can certainly make the case that they should be following what the industry does. So if the industry only says 2% and they're pretty much the same as the rest of the industry, that could be that they're writing off too much, or if they say that it's, it's 5% and the industry is 8%. Okay. Sales journal reconciliation with the accounts receivable journal ledger. Okay, what's a sales journal? All the way back to the very beginning.
Upstairs on the cell.
Yeah, you'll notice that when you make a sale on credit, it looks like this, right? This is the journal entry. Okay, and if you make one a day, that's not that big a deal. But let's say that you make hundreds of these a day, or thousands, or millions. Sitting down and having a journal entry made for each sale is probably not the best way to do it. So what they do a lot of times is they'll have a sales journal. They'll record everyone who's, they sold the things to, whatever they sold, and the prices and all that. And at the end of the day, this will all go in as one number. This was the daily, these were the daily sales for November 9th, 2023. So a sales journal is just a list of sales. Oops. Someone trying to get in? Okay, so list of sales that will be entered at the end of the period. And again, the journal entry will go in, all at once, basically. So you're going to reconcile like the sales journal, what was collected in the sales journal with the accounts receivable subsidiary ledger. So this will show you who made the sales, and the accounts, and those sales should show up in the accounts receivable subsidiary ledger. These will match up. The sales journal. So if you have customer A, bought $300, then you'll look to the subsidiary journal and you'll say, okay, accounts receivable, customer A, bought $300 worth of stuff on November 9th, 2023. Okay. What's in that? Sales and accounts receivable cutoff. This is actually a big one. And it's big for a number of reasons. I think maybe I did talk about this. I can't remember, to be honest. Sales cutoffs, along with the accounts receivable cutoff, is really important for. It affects both the assets, the sales that go on the income statement. It affects the assets that accounts receivable gets put on the books. There's also the inventory component to it. The inventory that you're selling is leaving, so you have this cost of goods sold, but also the inventory on the books, the amount, it should be reduced. So there's a whole lot of things going on with those, with a cutoff of it. And basically you look to the bill of lading. The bill of lading is the most important document in those, because that shows we put it on the truck, it's gone, that it's out the door. And that will be signed, and it'll have a date on it as to when they picked it up and all that kind of stuff. So the bill of lading is actually kind of the king when you're trying to figure out the cutoff for sales. But again, that's also, you got basically 4 accounts attached to that. You got the sales, you got the accounts receivable, you have the inventory and the cost of goods sold. And those are, for most companies, those are like the biggest accounts. So the sales cutoff, even being off by 1 day can have a really big impact on it. Okay, so I'm just going to put that you usually use the bill of lading, and we're going to do this later on. And if you've been around in business, you'll hear people talk about holding the books open. Have you guys ever heard that term? That's when they record sales that are made after the end of the year, and they record them in the previous year. So they make their sales numbers or whatever. So a bill of lading is usually used to determine what is shipped. Bill and hold. Okay, this is when the item, I should say the inventory, is not shipped, but the client is billed. This is a very tricky one. Why is that one so tricky? So here's how this happens. Someone calls up and they say they want to buy, this pen or whatever, and I say, okay, I'm gonna ship you the pen. They say, you know what? We don't have room for the pen. Then you're kidding. They say, no. They don't have room for the pen, so I don't ship it. Well, we do want it. Go ahead and hold on to it. We'll tell you when to ship it. Go ahead and send us the bill. But we want the pen. We just don't have a place for it right now. Okay. So you put sold on this, and you go put the pen in the corner. What's the problem if you're an auditor looking at that? What could be the problem with that?
Deliver that order to someone else.
It's possible, it's possible it was never even an order in the first place. It's possible. Oh yeah, the customer said that they want it, but they don't want us shipping it to them, and we just, they sent out a bill and they show you the bill they sent out. There's not going to be a bill of lading. It was never shipped. It's very difficult that's what they call a bill and hold. That you bill somebody and you hold it, and there's some very stringent strings attached to that, whether you can count that as a sale or not. Generally speaking, it has to be something very specialized. It has to be an order that cannot be canceled. There's a few other hoops to jump through, but so it's not shipped, but the client is billed, so they'll put a sold sign on it, and these are usually a no-no. And yeah, it's possible they sold to somebody else, and it's that it wouldn't be a sale at all. Okay, pledging accounts receivable. Pledging it as collateral. These pledging accounts receivable, it could also be selling of accounts receivable. Let's say sales of accounts receivable too. Okay. Why doesn't it like that? Oh, it doesn't like where I put the comma. Okay, pledging. So this is when accounts receivable are used to secure a loan or sold to the bank. And the reason why this can be a problem is that the question is, do they still, does the company really own these? You know, any cash collected on those accounts receivable is gonna go to the bank, you know, to pay off the loan. Or if they're already sold to the bank, that, you know, the bank's already given them the money for it. And their collection is basically, it basically is that it's an IOU to the bank. It's payable to the bank. So these are all kind of things kind of complicated, but the big thing about these is how they should be shown in the footnotes. Not food notes, footnotes. And explaining that. Okay, let's stop here. And let's say be back at, oops, that's not how you spell back. Yeah, I'll be back at, it's 6:56, let's say 7:06. Okay. So what page did I get to? Only that was page 2? You're kidding. Man, do I talk a lot. All right. things. Oh, well. Okay, let's go ahead and go through this. Is it time? Yeah, it is time. Okay. All right, confirmations. That was weird. Let me stick my tongue out. Confirmations are, in this case, in accounts receivable confirmations, you have the customer, the accounts receivable on the books. And you want to get a confirmation that whoever is on the other end, that they actually bought the stuff that's on there. And even if they have a bill of lading, it's possible that, your client overshipped it. People didn't actually order the stuff, they just shipped it to them and billed them as if they were, to make their sales look larger. So one of the things we do is we do accounts receivable confirmation, and it's moving up all that, the sales invoice and all that packing slip and all that kind of stuff. It's moving it up the chart to we're trying to get it up to here. So this is what a confirmation is trying to get. That you'll get something, the confirmation will come back from the third party, and it's held by the third party. It goes directly to the auditors, and it changes it from medium or worst evidence into the best. And so we're always trying to move stuff up the thing. Okay. Positive confirmation. Positive confirmation. Oops. Must be returned to the auditors. So all positive confirmations must be returned to the auditors. Let me change it. Let me say all positive confirmations must be returned to the auditor. So if you send out 100, you have to get 100 back. Now, these confirmations that send out, and say, okay, do you really owe this amount? Which ones are you more interested in? The ones that that there's no problem with, or the ones that there's problems with? I'm sorry?
With problems.
Yeah, exactly. Negative confirmations are a little bit different. They say to return the confirmation if there is a problem. If there isn't a problem, then disregard. Are you in disregard? Maybe not. Okay. So negative confirmations are, look, we don't want to, if everything's fine, don't bother returning it to us. We only want to know the ones that are no good. Okay. So let's, these are just some examples of a confirmation. Here's a positive confirmation. It will be sent out on the client's letterhead. Why don't we send it out on the auditor's letterhead? So let's say we're auditing IBM. We send these out, it'll say IBM confirmation. Why doesn't it say the auditors?
Because that's for the client financial statement, not for auditor financial statement.
Yeah, it would. Okay.
Yeah, so I was gonna say that, it's because, the person or the organization to whom we are sending the confirmation, they should be able to understand that it's authentically coming from someone related to their client and not just random number.
Yeah, exactly. You know, you put the CPA firm's name on it. Well, we didn't buy anything from, you know, Deloitte and Touche. We didn't buy anything from them. You know, so you always put it on the client's letterhead. So like, okay, this is IBM, you know, IBM sends this out. Do you owe us, or do you owe IBM this amount? Yes or no? If the amount indicated above is not correct, then please explain the discrepancies below. So they pay one years old and they return it. Usually give them a self-addressed envelope. They return it to you, and it goes directly to the CPA firm. The client does not get it. We want it to go to the CPA firm because we want it to be the best evidence that the client cannot touch it. So that's a positive one. A negative one, similar. You know, you say, okay, here, here's the amount that we that you owe. Is the amount correct? Yes or no? If the amount indicated is correct, please disregard this confirmation letter. Okay, so sorry. Okay, if everything's if this is fine, then just leave it. If the amount is not correct, you know, then you tell us what the discrepancy is below and return it to us. Amount is not correct, return it to the confirmation to ABC. Okay. Now let's think about this for a second. Which one of these is going to be better evidence? And I'll give you a little more of a hint. There's a problem with the negative ones. What is it?
Yes, it means like, someone just doing this reply or one to get it. At times, someone just doing something.
Yeah, part of the problem is the negative ones. They may not reply to it. You know, they may, oh, this is, you know, oh, this is stupid. These guys are idiots, and throws it in the garbage can. You don't get it back. So when you don't get one back, it doesn't necessarily mean that everything's okay. It could also be sent to the wrong address. You know, or the delivery person could give it to the wrong house. Like my stuff that always goes to the neighbor's house. You know, there's if you don't get it back, it doesn't necessarily mean everything is okay. So the only thing you can really make out of the negative confirmation ones is the stuff that you do get back. You know, if there is a reoccurring problem of whatever it is, you might see it in the returns that you get saying, okay, this is wrong because of X, Y, and Z. Someone else sends one in and says this is wrong because X, Y, and Z. You go, okay, X, Y, and Z is a problem. Well, we can look at it. But the ones you don't get back, you really can't make any kind of a judgment about it. Now, positive confirmations are better. They say, well, why don't we just use that? Well, we don't just use that because these are actually much more expensive. You send them out, you send out 100 of them, you get back 82. You send another set out, you get back, now you're up to 87. You get on the phone, you call these people, you get back 5 more of them, and you know the last ones you're calling them, and they're like, I don't know, yeah, you buy a fax machine, okay, I'm going to fax this over to you, and you're going to fax it back to me. You know, it takes a long time. They're more expensive, obviously. Okay, so we're going to see when we want to use these. You know, when do we use the positive? When do we use the negative? There's pluses and minuses to both of those. So let's see when we actually do it. Okay. We just talked about this. Which type of confirmation is better evidence?
The positive one.
Yep. Positive is better. Yeah, we get them all back, and you know, they threw it in the garbage can, or they didn't get it, or whatever. We follow up on it. Number 2 is why the best evidence is not always used. And part of it is the expense. So let's say that we have 2 options for testing something, A and B. And we're equally happy. So we have 100 positive confirmations, cost of $20 each. Now, if we do negative confirmations, it's not a good evidence, so we have to have more of them. And they'll cost $3 each on average. Okay, so which one do we choose?
I will
so-
choose the A.
Well, okay, the A will cost you
2,000.
2,000. And the B,
150.
yeah, 1,500. So it is possible that you sometimes will choose the, not the best evidence, because the best evidence is too expensive. And on some level, you gotta remember, you're spending the client's money. So, you do have a little bit of responsibility to try to keep the cost contained for it. But in this case, if you're equally happy, you would probably go with the 500 negative confirmations, because even though it's not as good of evidence, if you're equally happy, it is cheaper. Okay, so when do we use positive confirmations? There actually is kind of a, when there are few accounts receivable. Oops. And they are for larger dollar amounts. Okay, so positive confirmations are the appropriate when there are fewer accounts receivable and they're for larger dollar amounts. So you have, 15 customers and they're all $500,000 accounts. Okay, you send them out to all of them and you use positive confirmations, you get all of them back. Any one of those confirmations might be material. Well, it's just the opposite for negative ones. Negative ones are when there are a large number of accounts receivable, I should say many. And they're for small dollar amounts. Smaller dollar amounts. And if someone doesn't send one back, it probably isn't that big of a deal because these are smaller dollar amounts. It's probably not going to be a material, one account is not going to be material. Whereas the larger ones, maybe it is. Okay, so positive confirmations, they're more expensive. You generally use those for accounts receivable with larger dollar amounts when there must be one. Okay, well, when there is one, any one could be material. Negative confirmations, $50, $100, whatever they are. Even if there is, if they miss one, it's not going to be that big of a thing. Okay. Did we go over the? I can't remember. Did we go over the relevant assertions? And we must have in the cache. Did we go over that or no?
We didn't go over.
We did?
No.
Oh, okay, good. Well, let's go over them now. These are the relevant assertions. Whenever you do an audit, these are what you audit to. So for instance, if they say they made a sale on December 31st, you want to see if they made a sale, did it occur? If they say they have assets, okay, do they exist? So let's say you find an asset that exists, you find a piece of machinery and you say, okay, this exists. Okay, well, just because you found the machinery doesn't mean necessarily that they own it. They may be leasing it, or renting it or whatever. So if they are, then they may not have the right to it. It may not be theirs at all, even though it's sitting in their factory. Completeness, that they get everything cut off. So everything that we do in auditing, we test to these assertions. These are from the PCAOB. We don't have to get into that, but so these are what we test towards. some of these are a little bit difficult. This first one, I think, is one of the more difficult ones, actually. Accounts receivable confirmations. Which one of these are probably the one that is most tested by accounts receivable confirmations?
Maybe completeness and cutoff, valuation, allocation and currency, existence and occurrence.
Yeah, those are, it could go into a number of these, but yeah, the one that the most people think about is valuation. I'll talk about that in a second. The one that this really hits on, though, is existence. Do they exist? Do these accounts receivable exist? And that's really what you're looking at. Now you say, well, wait, what about the valuation? These people are sending back, these things saying, where they're wrong or whatever. There's a problem with that. First of all, if they're negative confirmations, you may not get them back any of them. But also sometimes people complain and they're wrong. They say, well, we don't know this, and you look into it. Yeah, you do. Here's the delivery. Here's a proof of delivery. Here's the bill. You do owe it. So a lot of times, the valuation of it. Another thing that is about the valuation, that even the positive confirmations could go wrong. Let's take this. You send this out, you get it back. Yeah, that's all fine. Well, what you don't know is maybe there's one or two invoices that isn't on there. And hopefully people will be honest and say, well, you know what, actually we owe more than that. We don't owe 36,000, we own 82,000 or whatever. But a lot of times you may not. So if there is something missing on that, sometimes it would be reasonable to assume that the customer is not going to say anything. So there is a problem too, that even the positive confirmation may not be accurate as far as the actual valuation of it. But what it does do a lot of times is it will tell you whether it exists. Did a sale actually happen or not? If it comes back and says, we have no idea what you're talking about, that could be a problem. So the one that tests the most, and this is a tough question, is the existence. It does move up to these other ones here in the cutoff and all that kind of stuff, but the one that it focuses on the most is, did it actually exist? The people that actually get something. Okay, which of the assertion is aided by the sales cutoff procedure?
Valuation should be there.
Which
and
one?
Cutoff.
Yeah. Yeah, probably the ones that the most are the completeness and the cutoff, and the existence, and more importantly on this one, the occurrence. Did a sale actually occur? And two, you gotta be aware too that sometimes companies may be trying to make themselves look worse. Why would a company try to make themselves look worse? Be less profitable? Why would a company want to look less profitable? I'm sorry?
What about the valuation? Because when you made the cutoff, you need to know the value.
Could be, yeah, the value of, like, say, the inventory or something. But yeah, so what did I ask? I forgot.
Why a company would want to be undervalued?
Oh yeah, why would they want to look worse? Why would they want to show less income?
Is it for tax purposes?
Taxes. Yep. Yeah, and you'll find people sometimes that they won't record, they have no cash sales in December. In January they make a huge deposit. So yeah, it could be that they just don't want to pay the taxes on it, so they it could go both ways. They could try to make themselves worse. Okay. Which sales and accounts receivable assertions are aided by analyzing the cutoff bank statement? This one could be a number of them, but. And so this actually kind of goes back to the first one, the first chapter 10. Well, the obvious one is the cutoff. You
The
cut off-
value can also.
yeah, it could be it could be,
Yeah, that's what I was thinking, E.
yeah, it could be a number of these. Yeah, the cutoff bank statement actually does an awful lot. Probably not so much with these other presentation, disclosure, rights and obligations. Well, I take it back. Well, no, it would be on there. Existence or occurrence. Was it actually a sale or not a sale? That if you find out, say, that they were doing something like kiting, you could pull that out of the cutoff bank statement. So they say it exists when it doesn't.
About classification also can be classification, can be presentation.
Yeah, well, presentation and disclosure, these are usually categories, where they put the assets in that. The presentation and disclosure, it can be in there. I mean, but when they talk about presentation, they're sort of like saying, is the cash account where it's supposed to be? Is it with the assets? Is there a disclosure on, say, how they're keeping track of their inventory and stuff like that? Is not generally saying if it is misstated. It's the presentation of it. I'll give you an example. It relates to this. What if you have a negative accounts receivable? What is a negative accounts receivable? So the negative accounts receivable means you owe the customer. Is that really an accounts receivable? What is it when you owe the customer or owe anybody? Payable. Yeah. So it's possible that you have a category problem and that you are showing a account with accounts receivable, even though it's negative, when actually that should be a liability. So that would be a presentation problem. And you could get that. I guess you could get that off of you could get it off of confirmation. Okay. I'm just gonna kind of bomb through these a little bit. Are accounts receivable confirmation required generally by US standards? Yes. You have to have a really good reason if you don't. What would be a really good reason? A really good reason, maybe you only have one customer. And in that case, it would just be going over that contract or whatever it is. But generally speaking, in the US standards, you have to have it. International standards are a little more lenient. They say that no, you are not required. You're certainly encouraged to do whatever you need to do to get comfortable with the accounts receivable amounts. The auditors may use other methods. And you find this true with the international standards. For instance, in this case, what could you do? Well, you might use a bill of lading. Yeah, there could be a problem with a bill of lading that they overship something or something like that. But possibly you could use a bill of lading to get comfortable with the accounts receivable. So international standards are usually not as rigid. They can have problems. There's been some big audit scandals with this one that there was no confirmation sent and they were fictitious sales. Okay, number 6. Who should be authorized to write off accounts receivable? That should be
Management.
anyone not in accounting, basically. Accounts receivable is an accounting function, and you don't want to have somebody in accounting writing those off. You don't want anyone in sales. I should say anyone not in accounting or sales. How about that? So can you have someone from the treasury write off? Yeah, you can have someone from the treasury write off. But you can't have anyone in accounting. They have the responsibility of record keeping and, yeah, the, you know, the authority for it is going through the, whoever's not in any of either of those. Okay, clearing accounts receivable. This is when you get accounts receivable confirmations back. And you have to do in auditing what they call clearing them. And clearing them is when you come up with a problem. And by the way, if you when you start auditing, make sure you talk to your senior before you put something in that needs to be cleared. Nothing gets them more angry than you putting down some kind of an audit point that they have to explain when they don't want to. So you always check with them. But you get back these confirmations. They have all these things that they say was wrong with them, and you have to clear each one of them and see what was, you know, what's going on with them. Okay. Audit steps to clear the accounts receivable confirmation response. Okay, so first one I get back says we never received the last shipment listed. Think back to our documents. What would we probably look at? Which documents would we probably look at for that?
The proof of delivery or the BOL?
Yeah, bill. It could be bill of lading or the proof of delivery. Proof of delivery would certainly prove if they actually got it.
What would prove that it was delivered, not that they got it, right?
Well, for proof of delivery is that they'll have that they actually it was delivered. Now, a bill of lading is also a good one though, because a bill of lading, you got to remember that, you know, the client isn't actually shipping this thing themselves. Someone else is usually a shipping company. So a bill of lading will be proof that something was shipped out. And again, because if it actually did get lost, if there is no proof of delivery and it actually did get lost, all is not lost for the client because they'll probably file an insurance claim on it. So they probably will get the money for whatever it is they were shipping, or at least some, you know, at least the value of it back. So these are probably the two things you'd look at: proof of delivery and bill of lading. And the bill of lading is actually a really good one because it shows that there was an honest attempt to sell something. You know, do things get lost in the delivery? Yeah, but a bill of lading shows that something was actually shipped to the customer, and that should match up with the invoice. Okay, number two, about $3,500 of this invoice had been returned on 12/9/2023. Okay, this, I don't think, I know I didn't talk about this. There are two things that there could be. There could be what they call an RMA, which you guys are probably familiar with. It stands for Return of Materials. And that's an authorization of return materials authorization, I should say. So there's an RMA, and usually that'll come from the company. Someone say, hey, you sent us the wrong stuff, and they say, okay, here's the RMA number, and they send it back. And there should be a receiving report. And the receiving report will be in the receiving department, and they will write up a report that says that they actually received it. Now, if you cannot find those two things, then you have a problem. Now, if you find the two of those things, there's a problem anyways, because they should have had their account credited for that if they actually returned the stuff and there's a receiving report. But if you can't find those two things, there is the possibility, you know, you check the bill of lading, check for proof of delivery, that they never did read. You know, you may ask them for a proof of delivery. You know, you gotta remember, you're dealing with people here. So sometimes people think they returned something, but they didn't, or, you know, oh, I thought I returned that, but my husband actually took it and put it in the backyard or you know, whatever. Okay. Number three is an interesting one. I already paid this on 1/6/2024. Okay, so we sent these out as of 12, saying, did you owe this on 12/31/2023? So as of 12/31/2023, did you owe this? And they say, I already paid this on 1/6/2024. The check number was 14, whatever, 14288. There's something a little bit humorous about this one. What is it? I'm sorry?
Well, they paid it in the future.
Yeah, they're actually, this is actually a confirmation that they did owe it. Right? I mean, they're saying, hey, I already paid this, but the fact of the matter, they paid it on the 6th, so you must have owed it on 12/31. So this is actually this is a confirmation. You know, they paid it, yeah, in the future. Basically, they paid it 6 days or whatever after the year end. So it's actually a confirmation. Now, you may still go look at the checklist if you want.
Bank statement.
Yeah, and what is it? Deposit slip. Yeah. So if you really wanted to look at the you know, to see if that what actually happened to the check, you could actually, you know, check to make sure that that's is okay. But you could just look at this and say, okay, they just told us that they actually owed it on 12/31, or they wouldn't have paid it on January 6th. So this one's actually a confirmation that they did owe it. Number 4, not our order. The entire order from 12/12/23 was returned on 12/15. This is another customer's order. Your company is stupid. This one's going to be hard to prove, but all right. So what do we do with that? That's kind of like this one.
Maybe bill already also.
Yeah. This is, so you'll see. Now it could be that there's a problem with their, you know, this is the second one that says they returned something and that they weren't credited for it. So while it might, you know, you still go through and see if they, you know, if anything was received, this could definitely be a problem with the company itself. This is the second one where someone says they returned something and it wasn't credited on their account. And this is kind of what you look for when you're doing these is there a problem
Well,
with,
is it saying that it's not credited? Because it says this was another customer's order. So it seems like the data is not correct.
yeah, it could be. I mean, they've obviously were billed for it, because that's what we sent it out for, but yeah, this is another customer's order. They have a problem with their shipping. You know, their shipping and the returns could be a problem. These two together, you know, these two are a little bit concerning, not because necessarily of what they are by themselves, but they may show that there's a problem with, in this case, mixing up customers, not giving credits back to customers when they return stuff. You know, check to see if it was returned. If it was returned, then you know you may have a problem with the internal controls. And this would tell you to go test the internal controls. Well, how are you guys actually shipping? How did this one actually go to a completely wrong customer, and you know, and someone else returned 3,500 and it never was to their account? Okay. Number 5. This total seems too high. Whoa, whoa, whoa. What's with all the information? I'm not a computer. So someone says this total seems too high. What do you do with that? how could you find out what the total should be? Well, one thing you could do is check and see if the items that were shipped match up with the invoice. So you could take the sales invoice and compare it to the bill of lading. And if those match up, and those match up with the totals, that's one thing you could do. So compare, oops. Bit of the bill of lading with the sales invoice.
Well, also, you would go into the AR aging to see if the deposits were reflect on her account or his account as well.
It could be, yeah. Yep. Yeah, and you know, especially if this company has trouble with the you know, with their controls, it is possible that there are things that are, you know, falling through here as far as crediting accounts and that sort of thing. Number 6, my favorite one. Per company policy, we cannot disclose any private information regarding our vendors. Company run by lawyers. What do you do with that? Probably along the same lines. Compare what was shipped with the sales, and you know, you don't want to do this for everyone, but if you get the handful that, you know, you may pull a bill of lading, pull the sales invoices and see what, you know, if they match up or they're pretty close to it. Okay, last one. We picked this up at will call and paid cash. We don't owe anything. A copy of the cash receipt was included in the return envelope. Well, first of all, what's will call? You want to know? What will call is if you have a company that's shipping stuff all over the country or the world or whatever, you may also have local customers. And local customers say, well, I don't want you to ship it. I'll just come over with my truck and, you know, pick it up at what they call the will call. And the will call is just a department where usually local people will come and pick up their stuff without getting it shipped. And you know, the second that they put it on the truck, it's a sale, and they go. You know, it's not, there's no shipping document or anything like that. But they said we picked it up at will call and paid cash. We don't know anything, and they show a copy of the cash receipt. But this got shown as an accounts receivable. So what is your question about this one? What happened to
The cash.
the cash? Right. This one might point to a bigger problem, and that there might be a lack of controls on the cash. And of course, cash is one of the things that is the most desirable thing to steal from a company. So this one may indicate a lack of control on the cash. Cash receipts, at least at will call. So this one, while it may seem kind of benign, is actually could be a serious one, and that it could indicate that there's a problem with the cash. You're paying cash, and that, you know, that And if this doesn't come up before, they may even have somebody in accounts receivable that's writing them off. They're taking the cash, they're putting it in accounts receivable, someone in accounts receivable is writing off the accounts receivable. So this could even be more serious. Okay. You know what, we're not gonna finish this. I tell you what, we'll do this one together, and I'll send you what the other one to do at home. But I want to do the we'll do the I'm going to postpone the test. I'll send out the test next week. Okay, let's see if we can get through this one though. So here we have invoice information for the year end 12/31/22. And here's a sales journal. And so this is kind of the cutoff that they're using. It looks like, so down to 12/31, they'll say is in 2022, and 1/1 will be in 2023. So there's our cutoff for the sales journal. Now, we go to a bill of lading. And these are the bills of lading. And these are what we're going to actually use for our cutoff. Okay, so which invoices should be included in the 2022 sales? I think this came out of, I think this was a CPA exam question. Okay, so what we're going to do is match up the bill of ladings to see which ones we should actually count in year-end sales. Okay, so let's take the first one, 3782. So that one should be in year-end sales. I don't know why I spaced it like this. I'm gonna change this a little bit. Okay, so here is the sales journal, and the sales journal is probably what they're going to use for their financial statements, at least throughout the year. But at the end of the year, you want to see what they actually, which ones actually were shipped. Okay, 3783. $37.84. And $37.85. Okay. So which invoices should be shown included in the 2022 sales? Okay, so I'm just gonna copy this down into here. And I'm gonna take out this one. That one was not in the sales. I'm gonna take out my line here too. Okay, so this is what they should have had in the sales. Those 4 invoices.
$3,100.
3,100.
1,100.
How much? 3,100?
Yes.
Yes.
Thank you. You guys are so much faster at that than I am. All right, so 3,100 should be in there. Okay, so if all the 22 invoices were included in the 22 sales, what correction is necessary? Okay, so, well, if we just take the 22 invoices, I'm going to get rid of this because we don't need that. So these are the 2022 invoices.
$4,800.
4,800, thank you. Oops. You told me the right number, I put the wrong one in. Okay, so this is what they're gonna show on their books for those invoices near the end of the period. This is what they should have had in there. And they have 4,800. So what would the correction be at year end? The sale, they're gonna be, the sale's gonna be too high or too low?
The sale will be too higher.
Yep, yep. So correction, so the sales are overstated, oops. By, whatever, 48 minus 31. 17?
1,700.
Okay, so this will be, 1,800 minus 100 equals, so 1,700, these are overstated by, so you tell them they have to take off 700 of those, 1,700 of those sales. And so again, you go by the bill of lading, you know, the accounting system might pick up the, you know, the sales invoices, when the sales invoices, but actually it's when they get shipped, is when you actually count them as a sale. Okay, so here's what we're gonna do. So next week, do this one for homework, see if you can figure out that one. And I will get, I will get the tests out. Is there anyone else who did not receive the test? I know that, Kayed and Huzafia, is that how do you pronounce it? Huzafa? Okay, anyway, is there anyone else that did not get the exam from last week? Okay, it's due tomorrow. If you did not get it, don't worry about that. You can get, when you get it, get it by next week, that'll be fine. Okay, I don't think we have anything to turn in, do we? No. So next week, so here's what we're gonna do next week. Oh, well, let me put this up for next week. So for next week, we're gonna finish, we'll finish this, this will be next week. And also we will do the, and we should get both of these done, obviously, the sampling overview. Will be next week too, and we should get both of those done. Okay. And I got both of you in for here. Yep. Okay. Very good. Any questions?
Professor, could
Yeah.
you upload the Zoom recordings?
Can I do what?
Could you upload any of the Zoom recordings?
Yes, I do. Actually, let me show you. Wait a minute. No, not there. Let me sign into Blackboard and see. The Zoom recordings are. Recorded Zoom meetings. And so these are the recorders. So week 9, so these are all on YouTube, and they should have closed captioning. That's why I put them in YouTube. How come I always look confused? Do I look like that in real life? And this is, I know. Yeah, so they are included in, oh, I just got out of it. I'm stupid. But yeah, they're in there, the recorded Zoom meetings. And now it takes a little while to get them. Basically, it has to render them here on the computer, and then when I go home, it has to render them and then upload them into YouTube. And the reason I use YouTube, so yeah, it's under the recorded Zoom meetings. The reason I use YouTube is that it's closed captioning, which for the ADA, the American Disabilities Act, they need to be closed captioned. So that's why I use, and the closed captioning on YouTube is way better than Zoom. So that's why. Any question?
Thank you.
All right. Yeah, so and they usually give me usually around midnight, but certainly by tomorrow. Okay. Question?
I just want to know, do we need to send a definition?
I got it. I got it in here for both of you guys. So Swati and Jincy. Kayed contacted me. He didn't come in, but so you've been here for 3.
Yeah.
Yeah, and you've been here for 2. So yeah.
Thank you so much.
You're welcome. See you guys. Okay. Okay. Any other questions? All right. Let's call it night. I'll see you guys in a week. And by the way, if you have any other questions, you feel free to contact me during the week.